Hey guys, it's Max. How's everyone doing? I hope you're having a great day. It is a beautiful day here in Austin, kind of a little breezy, but nice and cool. I want to get this over with so I can take Jackson on a WALK. He's sitting right next to me right there. Good boy, Jackson. All right, I have what I hope, like usual, is going to be a good one for you, but we shall see. The name of the ETFs are, the tickers are EGGS, Edward, Gary, Sam, and EGGY, Edward, Gary, Yankee. That's from NestYield is the name of the company. All right, so these ETFs launched, I think, Thursday or Friday. One of them's called the EGGS. It's called the NestYield Total Return Guard. That's, I guess, what the G's for. The other one is the NestYield Dynamic Income ETF. That's EGGY, and I'm thinking the Y is maybe for yield. Both have an expense ratio of 89 bips. So EGGS, think of it as more of a growth-focused fund. It's going to focus on providing income and some share price exposure to some upside is what they're going to focus on. In addition, they're also going to hedge the downside. Now, EGGY, similar. They're also going to go for high income. They are not going for share price exposure, though. They're selling at the money options, going for high income. However, EGGY is also going to engage in the same risk mitigation activities that EGGS engages in. I'm hoping these don't have a lot of downside. So NestYield, I believe they're wealth managers related to Ramos Capital Group out of Downey, California. Now, they're owned by a guy named Manuel Ramos, and I visited with him in New York this summer. Now, he was telling me about this ETF project that him and Jay were working on, and they were trying to convert his wealth management business into ETF customers. He has a large client base in Latin America. I bet these funds are big. He had his own. He had a entourage with him. I don't have a social media manager. He brought his social media manager, his wife, and a bunch of other people to New York. He's big time. All right. So, and of course, yes, Jay and Tidal are involved. Tidal issued the company, the ETF, and Jay, of course, is doing the sub-advising. Okay. So both funds have a three-pronged strategy. First of all, you get the curated, and I'm going to say a concentrated portfolio of equity securities. And they can either be owned directly or synthetically. Then prong number two is you have an option overlay. That's to generate income and also to kind of mitigate risk. But then prong number three is you had a separate option overlay, which is a put ladder, a long put ladder, not for income, just like a protective overlay. Okay, so it's three prongs: stock, calls, use a stock, short calls, long puts. Okay. Now, other funds use long puts, but I haven't seen one that has a separate SPY hedge. This may be the most aggressively hedged fund on the downside of the ones I talk about, other than maybe XVOL. And I didn't see anywhere if they're going to offer monthly or quarterly dividends. I even asked ChatGPT, and it didn't know. So on the website, they have a dead link where it says EGGQ. What do you want to bet? That's their tech-based fund that they're gonna release next. Here's what the website looks like. Look at that. It says, guard your investments, grow with confidence. NestYield Total Return Guard is designed to focus on U.S. large cap. They're driving innovation. By employing active management, EGGQ aims to provide a monthly income and implement strategies to hedge against market downturns. Invest in tomorrow, lead with innovation. All right, so let's look at the holdings real quick. Why don't we? Let's check out. There's that EGGQ I was telling you about. It doesn't go anywhere. So EGGS is a growth fund. So it's 7 to 15 companies. They start with the universe of I think they start the universe of all the funds in the S&P, and then they narrow it down to 25, and then from there narrow it down to 7 or 15. So pretty concentrated. So here's this one. Yes, it was the day after Christmas, so it's Thursday. It's been open 2 days. This here says a gross expense ratio of 95. Everywhere else it says a net ratio of 89. This one, it opened at 40. And let's just, I think I've already downloaded this, but let's just download it again. Okay, so they have Apple, they have shares, and they have an Apple caller. And not only that, look at their shares that they have. Their shares are at 255. Their short calls at 285. So they have 30 points of Apple upside. This is the growth fund. Now they'll get some money from this, not much though. But anyway, so on Amazon, similar thing. They own shares. Amazon's right around 223. They sold the 250. But then for protection, they bought the 227 put. Then in addition to all that, so even though they have some of these stocks, they have a call, or some of these stocks, they have puts on the stock itself, like Amazon. In addition to that, they have a separate tranche of SPY options. Look at this. So this is January 17th, March 21st, May 16th. It goes every 2 months out, and they get the same strike. They get the 545 strike. I'm going to show you what that looks like in option strat. There it is. That's a pretty mean looking foot ladder right there. I mean, the total, if the market dropped to zero, this says max profit 213,000. No, the market's not going to drop that far. That shows you how much total protection they have. Right now, I think the fund's around $1 million. So they have about a quarter of it protected. And if it dropped to zero, their gross stuff would be zero theoretically. So they lose all their money in the gross sleeve. But this sleeve would be worth $213,000. Now, obviously, that's not going to happen. But it wouldn't be the craziest thing to happen if the market dropped 15% in January or something, or February. So, and even at 15%, it could offset some losses there because it's a pretty nice low profit. Okay, so that's how that works. Now I want to show you the EGGS trade. I just pulled one trade out to show you. It was in Nvidia. Now Nvidia didn't have on a caller. They had on a call spread. So I just back tested the call spread strategy in Nvidia. So now what a call spread is you own stock. They have 800 shares of Nvidia, and the stock's trading around 137 or something. They sold the 145 calls. So they're long from 137. Then at 145, they're offset because they have a short. So now they're flat. So they're flat between 145 and 154, where they buy more longs. So they're long again. So you can see you're long under the market, which is 137. So that's why you have unlimited loss on the downside. But then also you have unlimited gain on the upside until you hit the 145 strike, at which point you've offset your long with the 140. So that's why it goes straight flat across here. You have a little dead spot where you don't get any enhanced return. But if the market keeps going, then you're back in business and you have theoretically partially unlimited upside. Mr. Ramos's group is going to pick the stocks and manage the stock portfolio. Jay's traders are going to do the overlay. So it's definitely a team effort. And of course, these funds hold cash and treasuries. That's pretty standard, especially when they use synthetics, they do that. So what I did is I'm just going to take the EGGS and I'm going to back test the Nvidia position. And I'm going to say they do that position every 2 weeks for the rest of the year. Those options didn't expire for 3 weeks, but I bet they roll them in 2 weeks or something. So I tried to simulate it the best way I could in the back tester. And the too long don't read is, if you would have just kept the same amount of money in buy and hold, just bought and hold Nvidia, you would have made more than 200,000. Doing the option strategy, you only made 99,000. So you had less total return. And that to me is not surprising because generally option selling strategies come with less total return. But they also come generally with some other good things too. So I would expect less income production than YieldMax due to the less frequent option writing activity. These guys look like they're writing options every 2 or 3 weeks. The other side is, because of the less frequent option writing activity, I would expect a little better total return than YieldMax. All right, so let's get into the back tester. Let me show you. Let me show you a couple of things real quick here. If you guys don't already have Tasty Trade, I would highly recommend getting it. If nothing for else, not for no other reason, just for the back tester. All right, so, but they have good everything too, you know. All right, let me show you what this is. So we're gonna say Nvidia. We're testing Nvidia. Okay, so the first one, buy call, sell put. If you guys watch Rod Station, you know that is a synthetic. Buy a call, and at the money call, that's what a 50 delta means. And you buy and you sell a 50 delta put, you've essentially bought the stock market. You're long Nvidia. You don't get a dividend, but you have the same upside and downside potential as Nvidia. So they have that trade on, and then they went out of the money, and that's where I showed you. They wrote the 30 delta, which turned out to be the what was that? The 30 delta was the 145 call. See where it says delta? Okay. So we have there that they sold. Writing means to sell. So you sell a call, one contract at 30, 21 days, and then you buy a put. I'm sorry. You buy a call, because remember they bought that further out of the money call. It's one, and that's a 10 delta. Now let me show you where I got that from. See this 154 out here? See where it says delta? It says 13. I just chose 10. I don't know why. Let's put 13 in there. Okay. So now what we're going to do, these are 3-week options. We're going to let them go 14 days and then take them off. So we aren't going all the way to expiration. We're going to essentially do a synthetic 2-week expiration. That's the way a lot of funds do it. These funds are only 2 days old, but I wouldn't be at all surprised if they're actually doing 2-week options, but they went ahead and bought options. They went ahead and did strategies that go out 3 weeks because they plan on covering them and rolling early. It's a pretty common thing. If they do something different, I'll come on and make a correction, but let's just run this kind of basic synthetic covered call strategy. Same thing that basically YieldMax does, or similar. Let's see how it would have done on NVDA over the past 3 years. And notice I'm not doing it over the past year because it's been a face ripper. The market's been good. Anything's made money. Over the past 2 years, anything's made money. Over the past 3 years takes into account 2022, which was not very much fun, if you guys remember. Okay, so let's look and see what we have here. First thing to look at is where it says buy and hold $210,000. That's kind of the bad news. The bad news is if instead of doing the option overlay, if you would have just bought the same amount of stock that it took to do all this with, you know, dollars for dollar, you would have made about twice as much total return. Doing the option overlay, even though you made some pretty good profit, you left some upside on the table. And that's kind of the way it goes when you sell covered calls or even covered call spreads. So let's now, I want to show you guys something. Okay, I've got some comments before that this fourth option, this deep out of the money 13 delta, you know, people always say, you know, it never helps out. It always expires worthless. You know, why do they even do that? Why don't they just save the money? Yeah, no, and I get that. And that is the way it looks. You can't always really tell with the naked eye. But when you run it on the back tester, there's a way that I'm going to demonstrate it to you, I hope. But yeah, I agree. It looks funny. And remember this, the fact that it's a 13 delta means it only is in the money by expiration around 13% of the time. So yes, 90% of the time it is a waste of money. But let me try to demonstrate the other side of the equation here. Okay, so let's just do this. Let's just take the darn thing off and switch this to just a covered call strategy. Now, what were we up? We're up about 110, I think, was the. Do you guys remember? Anyway, I think we're up about 110. So let's see how much we're up if we just do a covered call. So this has fully capped upside. All right. So what are we up? We're up about 80,000. Huh. Total profit and loss, $79,000. Okay. So here's the way I'm going to prove it to you. Wonder if we don't do any of these. Wonder if we don't do the synthetic or the short call. Let's just buy the 13 delta call by itself. We won't make any income, but let's see how much that would have made over the past 3 years. What do you want to bet? It's the exact difference between these two numbers. Well, let's go see. So I'm going to erase these other ones. And I'm going to add this one. It's buy call, but it's not the 50. It's the 13. 13 delta. Okay. 21 days. And then we're going to roll after 2 weeks. We're going to cover and put on a different one. Okay. So let's roll this back after 3 years, and it should add up to the difference, because that's the only difference there is. It's just that other option. Yes. And most of the times it doesn't come into play, but when it does, because the upside is unlimited, it can be mammoth. I mean, it can be huge. Something you would have never got otherwise. So this one, yeah, it's this, just doing the call, you actually beat buy and hold by 4 times. Why don't we just do the call then? Well, because look at we don't have any income details. It actually cost us $230 per trade. So if we're trying to do this in retirement, we need it. It's going to cost us money. So it's not as ideal as the strategies where we make money per trade. But you do have a lot of upside, of course. Anyway, but the gross, the money's exactly what I said. It's the difference between the two. This just adds in the difference between the two. So I'm going to go back to the original back test. So on the original back test, we didn't outperform buy and hold by 4 times. That's correct. We actually underperformed by half. But the reason we did this is because of this average premium. And this is a once a week trade. So that was once a week. In the $814, that's the amount of the premium you held on to. So even held on to more than all of it, 120% of it over the past 3 years. How much you hold on to has everything to do with if Nvidia is going up or down. But it's been a good 3 years for Nvidia, or it's been 2 good years for Nvidia, 1 bad year. So I think this is a fairly fair test. And all right, so now let's check out EGGY. I didn't back test it. It's a little more complicated, but let's just talk about it. EGGY sells an at the money option. And it also, in addition to that, owns the SPY ladder that I showed you. Okay, so I can tell that this one's going to have lots of yield because think about it. XYLD sells in the monthly cycle and still makes about 18 to 20% per year. They only pay you 12%. They keep some to guard the NAV. But this one should pay more than 12% because they're weeklies. These are every week. So, my guess is this is going to pay more around 30 or 35%, but yield, but not get a lot of upside. This one's going to be interesting too. So let's look at option strat. I did go in the holdings. I went in the holdings and they had a Tesla caller on. So I went and I put the Tesla trade on, and that's the Tesla trade. They had Tesla shares. And they sold it way out of the money, a 23 delta call. So, but then they bought a basically at the money put. So they can't lose a whole lot. You can see they don't lose $645 is the max they can lose. But should Tesla go up, they can make $3,000, and that's per contract. I didn't see how many contracts they had on, and they're still building these positions. Some of them they had on weird numbers. I bet you as money comes in, these positions should fill out. I'm going to keep an eye on them, but this Q strategy is going to be pretty interesting too. But let me try to show this in the Q strategy. So let me show you guys something here. Let's just try to prove something here. Let's do Tesla. So we're going to do Tesla covered call. Now they had a 23 call, so we'll do that one. Well, I guess we could just do the whole Tesla strategy. Then they bought a put, and it was the 50 delta. Okay, but they did this once a week, so these are only 7 days. All right, let's test this strategy and see how it would have come out for every Monday. Okay. Shoot, 3 different deltas. 50, 50, and 50. Oh, yeah. I ran this earlier and it did not come out well. But I think they're still building the positions. You know, these ones where they don't have any, where they do the at the money, that's usually what happens. So here's kind of what I wanted to show you. Let's do this, and let's I did it wrong. I'm sorry, that wasn't the at the money. Okay, so all right, yes, that's the way. I think I had it punched in wrong. Okay, so this strategy is really interesting too. This is a caller. Now let's see how they would have come out. This caller, this strategy right here, beat buy and hold by 10 times. What I always say, the reason they do this though is not for the, it's for this premium. Return on used capital. I'll keep watching this one. So I don't think this back test is right. I'm having a hard time simulating it exactly what I think they're going to do, because they're using shares. Tasty Trade won't let me use shares, so I have to use a synthetic. But a synthetic is a. Let me try this one other way. I guess that works. I mean, or now let's do it this way. I love how this strategy performed in 2022 when the market was down. Does anyone else see that? I'm going to have to do some more research on this strategy. And also, I'm not even factoring in the portfolio insurance these guys have with the put ladder. I don't have a way to test this Tesla trade and the put ladder. But anyway, I think the jury is still out on these, but I'm encouraged by what I see in this Tesla trade. I was discouraged because I see that it did not have a premium and income here. So, and I know they wouldn't do it that way. So let me try it one other way. I'm trying to simulate the stock, but this is just kind of a different strategy. All right, well, whatever this is, I don't like it as much because it certainly doesn't do as well during the bad times. All right, well, let me show you what I can show you. I've already showed you EGGS's holdings. Here's EGGY's holding. We talked about Tesla being an EGGY's, but EGGY's holdings are Apple, Broadcom, CMG, Google, Eli Lilly, Meta or Facebook, Microsoft, Netflix, NVIDIA. They have the SPY ladder there, the SPY protective put ladder. Then they have Tesla. Then they have TSM, and then they have Uber. All right, so I'm looking at Tesla. So they have shares and they have one option. So all right, so on Tesla, it looks like he's doing something different on this one. He has shares and he's selling a put. Okay, interesting. So it means he'd be double long. Well, let's just backtest that. So Tesla, we'll do a new backtest. So having shares is the 50 delta buy call and the 50 delta sell put. And then boom. And then he also sold a put. The put he sold was the 400, the stock's at 430. So it's an out of the money put. Okay. So he sold, that's probably a 30 delta. Okay. And he did this, and that's every week. Okay. Well, let's see how that would come out. I'm going to tell you right now, just by looking at it, that should be good in a bull market because you're double long. You're long through the short put and you're long through the shares or the synthetic. So let's see how this does. I haven't seen this strategy before. Own the shares and sell a put. It's just kind of like leverage. I mean, you're double long. You do great. As long as the market goes up, you do great with this one. All right. So on this strategy over the past 3 years, you can see this was not a winner. This lost $4,000 for buy and hold, and Tesla, even over the past 3 years, has made $71,000. All right, we'll keep an eye on this strategy and see how they do and maybe follow some of their trades or whatever. One thing I didn't figure in my estimates is the cost of the put ladder. I really do think these weeklies can probably pay 30 to 35 based on XYLD selling monthlies and being able to pay 15 to 20 or whatever they pay. They only pay 12, but being able to earn, 18 to 20. I think that, 25 to 30 is definitely doable. I think maybe even 30 to 35. Now then we're going to have to subtract the cost of the put ladder. So I'm thinking altogether, maybe this is back to 12% after you take off the puts. Okay. But so 12%, we're right back where XYLD is. Okay. That's true. But I'm thinking this may be a safer 12% than XYLD because, XYLD did very poorly in 2022. And, we'll see. We'll see. Hopefully EGGS and EGGY won't get a lot of downside. All right, not financial advice, of course, just like always. Please get a fee-based financial planner. The usual caveats apply to high yield funds generally. So don't use high yielders for more than 20% of your portfolio. In other words, this is for me. This is what works for me. I keep as much of my money as I can in growth. So, instead of having a 60-40, growth safety portfolio or stock bonds portfolio, I have a 60-20 stock and then government bonds in the 20. That leaves me 20% for these high yielders, which for me is about as much risk as I'm willing to take. The main thing, the most important rule is only use these if you need income. So these ETFs are effective tools for turning equity in the stock market, turning shares into spendable income. These ETFs are not effective tools for growing wealth, though. So buyer beware. All right, guys. I appreciate y'all for being here. Have a great day.